On behalf of the American Finance Association, the University of Chicago Graduate School of Business, and the Myron Scholes Forums, it's an honor and a pleasure to introduce Eugene Fama. This talk is being videotaped for the American Finance Association History Project, so we speak for the ages. Gene's going to tell us how the efficient market hypothesis developed, so I'd like to say a few words about why it's so important. This may not be obvious to young people in the audience, and I'm sure Gene is going to be too modest to say much about it. Market efficiency means that asset prices incorporate the available information about values. Why should they reflect information? Because of competition and free entry. If we could easily predict that stock prices will rise, or I should say maybe decline tomorrow, we'd all try to buy or sell today. Prices change until they reflect that information. Now this seems like a pretty simple theory, hardly worth all the big fuss. Maybe you were expecting general relativity with lots of incomprehensible equations. The efficient market hypothesis is more like evolution. Evolution and efficient markets are elegant, simple, and powerful ideas that organized and energized vast empirical projects. And that's the true measure of any theory. Without the efficient markets hypothesis, empirical finance would just be a collection of Wall Street anecdotes, how I got rich stories, and technical trading news sheets. The efficient market theory and empirical work are also a much deeper intellectual achievement than my little story suggests. It took nearly a century to figure out the basic prediction of an efficient market, from Bachelier's random walk to the consumption-Euler equation. It took a lot of hard work and great insight to account for risk premiums, selection biases, reverse causality, endogenous variables, and to develop the associated statistical procedures. Efficient markets empirical work doesn't just check off easy predictions. It typically tackles really tough anomalies, each one of which looks superficially like a glaring violation of efficiency, and each of which is endorsed by a cheering crowd of rich or maybe lucky traders. That empirical work consists fundamentally of applying scientific method to financial markets. Modern medicine doesn't ask old people for the secrets of their health. It does double-blind clinical trials, and to that we owe a lot of our health. Modern empirical finance doesn't ask Warren Buffett to share his pearls of investment wisdom. We study a survivor bias-free sample of funds sorted on some ex-ante characteristic, and we correct for exposure to systematic risk. To that we owe our wisdom, and maybe as a society, a lot of wealth as well. This point is really important now, a period of great financial turbulence. It's very easy to look at the latest market gyration and say, oh, look at that, surely markets can't be efficient. That's not how we learn anything of lasting usefulness. Efficient markets taught us to evaluate theories by their rejectable predictions, to do the numbers, to do real scientific empirical work, and not just to read newspapers and tell stories. Efficient markets are also important to the world at large. The assurance that market prices are basically right lies behind many of the enormous changes we've seen in the financial and related worlds, from index funds to market accounting and to modern risk management. Well, with 40 years hindsight, are markets efficient? No, not always, and Gene said so in 1970. For example, prices rise on the release of inside information. That means that information was not already incorporated in the price. This is great news. Only a theory that can be proved wrong has any content at all in the first place. Theories that can explain anything are just as useless as prices went down because the gods are angry. Gene went on. He argued that no market's ever perfectly efficient, since no market's ever perfectly competitive or frictionless. The empirical question has always been to what degree a given phenomenon approaches this unattainable ideal. Still, the answer today, I think, is a lot closer to yes than no in the vast majority of empirical investigations. It's certainly a lot closer to yes than anyone inspected in the 1960s, or that the vast majority of practitioners believe today. There are strange fish in the water, but even the most troublesome are surprisingly small fry. However, empirical finance really isn't devoted to debating efficient markets anymore. And any more than modern biology is debating evolution. We've moved on to other things. I think of most current research as exploring the amazing variety and the subtle economics of risk premiums, focusing on the joint hypothesis part rather than the informational efficiency part of Gene's 1970 essay. This is also great news. Healthy fields settle debates with evidence and move on to new discoveries. Now, don't conclude from that efficient markets are passé or that finance is boring. As evolution lies quietly behind the explosion in modern genetics, markets that are broadly efficient, in which prices quickly react to most information, quietly underlie all the interesting things we do today. And this is the best fate that any theory can aspire to. Now, Gene will talk about the history of efficient markets. People expect the wrong things of history as they expect overly complex theory. No lone genius ever thought up a hypothesis, went out to test it, convinced the world with his 2.1 T statistic, and retired. Theory and empirical work develop together. Ideas bounce back and forth between many people. The list of salient versus unimportant facts shifts. Evidence, argument, and, alas, age gradually change people's minds. Occasionally, one great mind puts it all together. This is how efficient markets develop too, and as Gene has always graciously acknowledged. Gene's 2 essays describe the ideas, but much less of this process. It was an amazing adventure, and historians of science should really love this story. Ladies and gentlemen, please welcome Gene Fama to tell us about it.
I'm not going to talk that long, and I'm going to talk very informally. I'm not good at giving formal talks. And as John said, I'm going to give you more about the history of the development of this hypothesis and the history during my lifetime, because it goes back, my academic lifetime, because it goes back much further than that. And I'm going at a note I got from Bob Lucas, who said he couldn't be here. He would like to be here, but he said, don't do the easy thing and tell him about your current research. Tell him about what was going on when we were students and then young faculty members around the University of Chicago. And that's what I intend to do. And let me say thanks to the AFA for doing this project, and hopefully somebody will look at this thing when you put it up there. Okay, so we're going back to basically the middle 1950s is when empirical work on efficient markets starts. Theoretical work you can trace back to Bachelier. There's a website that John sent me where this fellow traces it back to 1538, and the first person who ever worked on Brownian motion. That's not what I'm all about here. So you can go to that website and look at all of these obscure things. So all it says is ideas have very deep roots, and getting them all out is a very complicated business. But I'm only going to tell you about my history in this area. So the second thing I'm going to give you is just a little brief perspective on the context in which this work was done. Basically, finance didn't exist in the middle 1950s. It really didn't exist until work that started with Markowitz, his doctoral thesis in the economics department here, and then that masterful book that he wrote in 1959, which was the first really rigorous definition of risk of securities and risks of portfolios. But basically at the time, the important historical fact is that basically at the time when research on efficient markets started, there was no asset pricing theory around. Asset pricing didn't exist. The first asset pricing models we had were was the CAP-M, which came in 64 and 65, and then all the stuff in the 70s, ending up with the Breeden-Lucas consumption-based asset pricing model. But none of this was available. And if you want to see a good indication of it, go back and read the original M&M papers on capital structure and examine how they struggled with the definition of perfect substitutes. And they come down in the end to something they call the risk class, which covers everything. Basically, cash flows have to be perfectly correlated for everything in the risk class. And that covers every asset pricing model you can ever think of, but it's a very narrow definition of a risk class. But the point is that the basic problem, or the basic link between asset pricing and efficient markets just wasn't understood. So how did it happen? Well, Morris Kendall and Harry Roberts and people like that were basically statisticians. And computers came along. And this basically expanded their horizons enormously, even though the computers were toys, not toys physically because they filled whole buildings. but were toys relative to modern computers. But they were released from their mechanical calculators and able to do calculations that they couldn't imagine doing before. And what's the most easily available data? Securities prices. So there was lots of work looking at the distribution of securities returns and the behavior of the serial behavior of security returns. And people observed that if you calculated autocorrelations of stock returns, they tended to be very close to 0. And then they started thinking, well, what does this mean? What does this mean in a world where markets are operating properly? Well, then economists came along and said, if you think about how markets should work, basically the current price should reflect all available information, statement of an efficient market. So prices should change only based on unexpected new information. And that led to the random walk model of pricing. And all of this was going on, at least in my perception of it. It was all taking place here and at MIT. Here we had Merton Miller and Harry Roberts and Lester Telser. And when I was a kid, Ben Mandelbrot used to come quite frequently. He spent several quarters here. And there was just lots of talk about these topics. And then at MIT, there was Franco Modigliani, Paul Samuelson, Paul Kuttner, Sidney Alexander, people that were very interested in this topic. And there was lots of back and forth between those two campuses at that time. So I explained the idea that prices adjust to new information. That gives rise to this random walk hypothesis. The random walk hypothesis, well, people quickly figured out that that was a little bit too strong. Prices don't have to be independent, identically distributed. Basically, they have to be a fair game, which means they're martingales. And so Samuelson and Mandelbrot both wrote papers showing that, okay, random walks weren't what you need. You really needed a martingale. But there was something missing in all of this. So people didn't even understand when they were doing the tests that they were saying something about market equilibrium. So when I calculate an autocorrelation coefficient, if I think about it in terms of the joint hypothesis problem, what does it mean? What's my implicit assumption about market equilibrium? It's basically that the security or the portfolio that I'm looking at has a constant expected return, so that its returns are unpredictable based on past returns. And then there was lots of work. Nobody does this anymore, but I even wrote a paper with Marshall Bloom on filter rules. There was lots of papers on filter rules. You'd develop a trading rule and you'd test it. And the trading rules typically involved going long, going short, and the presumption was that there was persistence in prices. And the market efficiency hypothesis was that if the market was efficient, basically buy and hold should be the best thing to do. Now, if you think of that in an equilibrium context, what it says is expected returns are positive. So you don't want to ever be out of the security. Now, constant expected returns, positive expected returns, all terribly arbitrary assumptions, but they were implicit in this early work. And in 1970, I wrote this. The reason I don't want to talk about it, I've written 3 review papers on this stuff, believe it or not, on this topic, and I looked back at them and I said, "Gee, they're pretty good, actually." I don't have much more to say in addition to that. So maybe I'll just give them a little flavor, and then people can go back and read them. So this paper, this 1970 paper called "Efficient Markets: Review of Theory and Empirical Work," was in the Journal of Finance. Basically points out that you're always jointly testing market efficiency with some model of market equilibrium, which means that market efficiency per se is not a testable proposition. Now that doesn't bother me because the converse is also true, and that bothers nobody. Models of market equilibrium, asset pricing models, aren't testable without market efficiency because basically all of them assume market efficiency. So these two things are now inextricably linked, and I think everybody realizes that now. And as John said, much of the interesting stuff that happens over the last 30 years has to do with testing asset pricing models and then deciding whether they work or don't work because the model is bad or because the market's inefficient. Okay. Now, in I forget the date exactly, 68 or 69, we published this paper, The Adjustment of Stock Prices to New Information, Fama, Fisher, Jensen, and Roll, which has an interesting history. So I'll give you a little of the history. The history is Jim Laurie had gone to Merrill Lynch, or he had good friends at Merrill Lynch, and they wanted to know what the stock return was from 1926 to 1960. And so they gave him $250,000 to develop the CRISP tapes, basically, only NYSE stocks at that time. So Larry Fisher did all of the work. Jim didn't do it. Larry was amazingly foresightful in terms of figuring out everything you had to know to construct true returns. So they, 1962 or 3 or whatever, they published a number. And Merrill Lynch takes out a full-page ad in the Wall Street Journal saying, here's the return on stocks 26 to 60. It's great. Give me your money. But at that point, Jim said, he got worried. He said, I'd like to get more money from them, but they aren't going to give us more money unless they think these tapes are useful for something else. We have to figure, so on hindsight, of course, this is laughable because maybe 30% of all empirical work in finance uses the CRISP tapes, but he was worried that nobody would ever use these things. So he said, why don't you study stock splits? So that's what we did. And this paper gave rise to, I mean, it would have been done anyway because the data are there. This is something that had to have happened. We just happened to be the first ones to do it. But basically, this launched an industry, the event study industry in finance. I always think we've run out of events to study, and then another 200 event studies get published. So it isn't true. Event studies initially, they're like every other test, they're subject to the joint hypothesis problem. Initially, this wasn't a big deal because people were interested in what happened within a few days around the event. And if I'm looking at fairly big events, mergers, whatever, if I'm looking only at a few days around the event, it doesn't matter a lot what I call the expected return because it's typically tiny relative to the event return. But once I start getting interested in long-term adjustment of prices to information, now the bad model problem, or the joint hypothesis problem, starts to rear its ugly head again. And we've seen a resurgence of work on long-term returns has become very popular. And the topic is incredibly interesting. Of course you want to know whether the long-term adjustment of prices to information is efficient. But here the joint hypothesis problem just becomes devastating because what we've learned is that these tests are just very sensitive to what you assume about market equilibrium. So the questions are very interesting, but I'm not sure the answers can ever be terribly convincing about long-term returns. Now I should also mention what was Mike Jensen's thesis on the evaluation of pension fund, a mutual fund performance. This was just, we had a run of incredible theses at this time, and this is obviously one of the best ones, but this launched an industry of its own, which is performance evaluation. Now, in perspective, performance evaluation didn't exist. It did not exist prior to this time. All mutual funds were actively managed, and they all claimed they beat whatever they wanted to beat, and there was nobody ever stepped back and evaluated whether they actually did what they claimed to do. And Jensen set up this framework in the context of the CAPM. That was his model of market equilibrium, and he dropped a huge challenge on their heads because it didn't look like they performed very well. Now, Mike was one of an amazing group of students that we've had here over the years. So at his time, we had Richard Roll, there was Jensen, there was Myron Scholes, Ray Ball, Ross Watts. I have to be forgetting people. Marshall Bloom, and then after them, more they keep coming along. But this group had a big impact on research on market efficiency, especially in the early days. So I get a lot of credit for the stuff that they actually did. One of the offshoots of the CRISP seminar was we used to do this CRISP seminar biannually, which also was to generate interest in the CRISP tapes, but the participants were business people. And one fellow who came all the time was Mac McQuown from Wells Fargo. He was in charge of their investment business, and he was really attuned to this efficient markets idea. And Rex Sinkfield, who was one of my early students in my advanced course, an MBA student, he went off to American National. He was totally convinced. And the two of them, in their separate institutions, brought out the first index funds, which was basically, along with Jensen's performance evaluation, the first applications of efficient markets. Now, in those days, it took a long time for ideas to penetrate into applications. But one of the big finance, I had this in my first, talking too fast, but on my first slide, I had this notion that finance is the most successful area of economics. And I think that that's clearly true. In what sense? Finance is the most successful area of economics on the academic level because of the joining of theory with empirical work. We test our theories, and we develop meaningful tests of our theories, and when the theories don't work, we go on to other theories. This is the best scientific tradition. But there's also been a huge spillover of finance into applications. For example, before they got the Nobel Prize, I always said the options pricing model was clearly the most important paper of the century, the last century, in the sense that everybody going through a PhD program or an MBA program had to in finance had to know about it. Every PhD economist had to know about it, and a whole industry was built around it. So it's hard to imagine anything that had a bigger impact on the world. Now, efficient markets, less so, because even to this day, less than 20% of mutual funds, for example, are managed in a passive way. The rest, and that's way up from 10 years ago. So that hasn't really penetrated as much as I would have hoped. Okay, so that takes us basically through the period when I was interested in direct tests. Once I got clued into the joint hypothesis problem, I moved on to a different kind of test, and that's this market predictions of interest rates, inflation, and other macroeconomic variables. So this is like turning it around, saying markets are efficient, let's see what they can predict. And so the first paper I did in this tradition was interest rates as predictors of inflation. It's a paper in the AER in 1975, which basically says that during the period from 53 to 71, I call this the golden age of the Fisher effect. It's the only period in which it works. During that period, expected real returns on bills were relatively constant. And so the variation in the bill rate was basically variation in the expected inflation rate. And that when you regress the inflation rate on the bill rate, you got slopes very close to 1 and residuals that were serially uncorrelated. So at least to that extent, it looked like you were looking at the best possible assessment of inflation. Now, the simple idea in that paper is that if you want to estimate a conditional expected value, you put that variable on the left and you put the predetermined variables on the right. It's everybody does that now, but at that time, people were doing it the other way around. So they thought that expected inflation caused interest rates, so they would regress interest rates on inflation. And of course, immediately they have a huge measurement error problem in the regression. Now, this is a characteristic of my work. I came on this idea serendipitously. I mean, I don't know why I came on it, and then I applied it like 15 different times. So there are literally 15 papers that use the same approach. Some of them are about the information in the term structure, about expected spot rates and holding period returns. Some of them about forward exchange rates as predictors of spot exchange rates. And then there are tests of whether, how well stock returns forecast real activity and all kinds of things like that. So that took me another 10 years. And then we come to the time when Ken French comes here, and he has the office next to me, and we start working together, and I figure, here's a guy that's got incredible energy. He can keep my reputation going for another 25 years. So I hooked up with him, incredibly smart guy, same work habits I do, and we just work together very well. And the end result, not the end result, we're still writing papers, but one of the big results was this paper that we wrote in 1992 called The Cross-Section of Expected Stock Returns, which I never expected to get published because there's nothing new in there. There's absolutely nothing new in there. All we did was to take previous so-called anomalies and put them all together in one place. So what had happened? Well, the CAPM came along in 1965. People didn't start testing it until the early 1970s. So there were papers by Fama, McBath, Black, Jensen, Scholes, other people that tested the CAPM. And the initial tests looked like they gave pretty good support to the model. And then kind of in the early 1980s, we started to come across things that were causing embarrassments for the model. But they came up one at a time. One at a time these things came up. And so people looked at them one at a time and said, one thing, that's not too bad. So all we did was put them all together and say, look, this thing just doesn't work. And then came this so-called three-factor model, which was meant basically to capture the problems the CAPM seemed to be having with small stocks and with explaining the difference between value and growth stock returns. Now this is a good example of the conundrum posed by the joint hypothesis problem. So we developed this model to explain the size and value growth phenomenon, but then immediately a controversy arises. Lakonishuk, Slifer, and Vishny say, and others say, nah, this isn't a risk return story, this is just market inefficiency. And basically, the joint hypothesis problem says, based on that data alone, and based on any data I've seen since then, you really can't tell one story from another. Okay, I was going to say something about my research philosophy, but I'll skip that. Well, I'll say it. Why not? What's my research philosophy? Keep it simple. Keep it simple. Do things that people can understand. That's easy for me because I'm a simple-minded guy. If I can understand it, almost anybody can understand it. And my good friend David Booth told me 20 years ago, every business is 50% marketing. And academic business is not an exception. It's at least 50% marketing. The way you write has as big an impact on your impact in the world as a whole as what you actually do. So saying things clearly and simply is going to get you much further. The words, where did market efficiency, efficient markets come from? You won't see them in my thesis. They're not there. You won't see them in any other work up until that point. I popped them into this little paper that I wrote for Capital Ideas for the school. That's the first appearance of them. And then that paper got picked up by all these professional journals, and the term caught on. But that's where it developed. It didn't exist up until, it hadn't been used up until that point. So coming up with the name gives me a lot more credit for what was actually done than I deserve. Okay, we talked about this, we talked about that, we talked about that. Here are all the papers I wrote. I told you there are 15 of them, right? Did that? Okay, I'm done.